What exactly is supply and demand? How can you spot it on your chart and how can you take it in your advantage? My name is Bowie and let's get to it. Let's first discuss the difference between supply and demand. Supply in crypto means how much of that cryptocurrency is available to buy. And demand is how much interest there is in the cryptocurrency. Imagine you're going to the shop. Everything that's in the shop is the supply. It's basically how much products there are available to buy. And you and all the other customers in the shop are the demand. And supply and demand determine the price of a cryptocurrency. If demand is greater than supply, the price will rise. If supply is greater than demand, the price will fall. And if supply is equal to demand, the price remains the same. Let me ask you a question. Do you think that if price goes up, it means that there are more buyers than sellers? And do you think that if price goes down, that means that there are more sellers than buyers? I know that sounds correct, but it's not. I thought so in the beginning too, but here is how it actually works. Like, just think how crypto trades work. If there's someone that's willing to buy a cryptocurrency, there needs to be someone on the other hand that wants to sell that cryptocurrency. And if there's someone that wants to sell a cryptocurrency, there needs to be someone on the other side that wants to buy the cryptocurrency. And these transactions are automated by the exchange. If you place an order, your exchange will automatically set you up with a buyer or seller. So there will always be the same amount of sellers and buyers. So now you might ask, what causes price to go up or down? Well, I'm gonna tell you that right now. Price goes up because buyers buy up all the available sell orders that are placed on the market. And you need to see sell orders basically as the supply. Buyers buy the supply, they match up with a seller, so they buy up all the sell orders aggressively. And understand that price of a cryptocurrency is being formed by the highest buy order and the lowest sell order. So if buyers buy up all the available sell orders in the market, the next available sell order will be higher, higher, and higher, causing for price to go up. And the opposite, how does price goes down? Is it because there are more sellers than buyers? No, there are always the same amount of sellers and buyers. Price only goes down because sellers sell off all the available buy orders on the market. So when they sell off and match with buyers aggressively to the downside, the next available buy order will be lower, lower, and lower. So that way price goes down. And let's see this on the chart because supply and demand are very easy to spot. A demand zone is a zone where price stays above it. And why is that? Because as soon as price reaches this demand zone, the buyers buy up all the available sell orders so that the next sell order will be higher, higher, and higher. So therefore price moves up. And a supply zone like this right here is a zone where price stays below, because when price reaches the supply zone, sellers sell off all the available buy orders around this area. So the next few buy orders will be lower, lower, and lower because they sell off these transactions aggressively. So therefore price goes down. And supply zones are basically used just as demand zone, as a level where price can react to before going further in the direction it was heading to. For example, if you see right here, it touched the supply zone, sellers sell off all the buy orders, and it goes down afterwards. This demand zone, you see it right here, is being created by this big move up. This is the demand zone, and afterwards price touches the demand zone before going back up again. Okay, so now you know how supply and demand works in theory, but let's get more technical now. Let's start with the demand zone. So before you can spot these demand zones, you need to see two things. First, you need to see a consolidation of price, and second, you need to see a big move up called the expansion. So if you see and look at the chart right here, you'll see the price has been consolidating within this range right here. So it's basically moving up and down from this range high and this range low. And then suddenly price makes a big move up with this big candle right here, and this is called the expansion. This is the expansion. So if we see a consolidation of price and an expansion of price, then we can mark out our demand zone. So how do we do that? Well, the demand zone is the last bearish candle before the big move up, and in this case it will be this candle. This last red bearish candle will be our demand zone. And so what happens after we see this demand zone? Well, for that I need to go to a lower time frame. So what we see right here is after this big move up, price comes down eventually, because if price goes up, it must come down. It's how price works. So we call this move, this big move that created this demand zone, the expansion. And then we have the mitigation. The mitigation is more aggressive than the expansion. Is basically because people longed right here, the big players longed right here, but they didn't fill all their orders. So then basically price needs to come down to fill all the unfilled orders of the market makers before going up again. And this can be an opportunity to long. I'm going to tell you how like 90% of people, of smart money concept traders, long this demand zone. It's not going to work all the time, but it's a concept that many traders use. So they use their stop loss and place it below this demand zone. Their entry will be right at the top of the demand zone, and their take profit will be at the previous high. So they basically wait after the expansion for the mitigation to touch this demand zone and then going back up. So I don't really like to just use this simple demand zone strategy. I like to wait for price coming back and mitigate this demand zone and then wait for a bounce. And you don't want to go long right here. If price bounces up right here, you don't want to think like, okay, it's going to the moon. No, it's not going to the moon. This is the first bounce to let you think that we're going up. And then what happens is price that goes down again, hits your stop loss, and you're crying. You don't want to enter long right here. Just don't do it. Please don't do it. Then you wait for it to go up, break of structure right here, another retest of the demand zone, and this is where you would like to long. This is where I would place my entry. So wait for price to mitigate this zone, bounce up. You don't want to long this. You wait for another sweep of liquidity. This is a hunt of your stop loss, goes back up again, makes a break of structure with this high, goes back down and mitigate until the demand zone is retested again. And so this is for me the best possible entry. And it's the exact same thing but the opposite for a supply zone. So if you take a look at this chart right here, you see this big move down, but what happened before that? A consolidation. So the same for a demand zone also applies to a supply zone. You need a consolidation. It doesn't matter on what time frame. You just need a consolidation of price where price is ranging between a range high and range low. After that, we want to see a big move down or up. In this case, for supply zones, we need to see a big move down, and that is called the expansion. So this right here is the expansion, of course, this big red candle down. This is the consolidation. So now we have the consolidation and the expansion. Now we need to mark out our supply zone. So how do we do that? Well, our supply zone is the last bullish candle before the big move down. So the last bullish candle will be this right here. This will be our supply zone, because this is also human psychology. This bullish candle is being formed by the market makers. They know the price will go down, so what they do is they push price back up one last time so they can fill all their big orders right here, so they can enter at the best available position. Let me quickly go to the lower time frame so now we can see it better. This is the supply zone, and you see that after this big move down, price goes all the way back up slowly to fill all unfilled orders by the big market makers. So this is the same as the mitigation in the demand zone. The mitigation in the supply zone is going up to fill all the unfilled orders. So there you see that price moves and shoots back down after hitting this supply zone. So yeah, one way you can trade it is to enter short right here. This is how most people do. I don't like it. You'll get stopped out right here. So if you place your stop loss at the top of the supply zone, you'll see that this big wick will stop you out of your trade. So I don't want to do that. So what I want to see instead is price mitigating to the supply zone, going back down, and this is where everyone shorts the market. You don't want to go short right here, because then afterwards market maker will push the price back up. Right here you see stop loss hit, and I'm still not entering the trade because I use smart money concept. So price goes down again right here and makes a break of structure. You see it, break of structure, then goes and tests the supply zone again, and this is where you want to enter. You see, this will be a perfect trade. If you enter right here. Put your stop loss top of the supply zone, and then your take profit would be at this demand zone right here. So wait for price to bounce, sweep liquidity, break of structure, retest. This is where you want to enter. Of course, it will not always work, but this is the best possible scenarios to trade off supply zones and demand zones. So these are the basic fundamentals of supply and demand zones. If you learned something, don't forget to like, subscribe, and hit the bell, because I'm gonna be uploading a lot of crypto and NFT stuff. So I hope you have an amazing day, and I'll see you in the next one.